Hello students, I welcome you all to the 22nd video lecturing session on financial markets and services. We are specifically dealing with the second chapter, that is non-banking financial intermediaries. This subject is for the final year BBA, that is 5th semester BBA students of Bangalore North University and Bangalore University as well. Moving ahead, as I have told you, so non-banking financial intermediaries is the second chapter. In that, in this session, we are going to specifically learn about factoring, its meaning, functions, and steps that are involved in factoring process. So this is what we are going to discuss in another 15 to 20 minutes. So moving ahead, we have a quick recap of the previous class. In the previous class, we had discussed about venture capital investment process. You can go back to the video and you can just review it. Next, we have learning objectives of the chapter. It is same for all the sessions up to the second chapter. So that is for all the sessions of second chapter. The learning objective of the chapter is same. So next, the session outcome. This will be different for every session because we discuss different concepts in every session. So by the end of this particular session, the students should be able to, that is, you should be able to define what exact factoring is and explain the functions of factoring, that is the facilities or tasks that are done by factoring agent or intermediary, outline the process involved in the factoring. So who is a factor? A factor is a financial intermediary that purchases the receivables from a company. So then when do we get into the picture of, when do we get the picture of receivables? So whenever a seller or trader sells his goods on credit basis, there comes, the existence of or the picture of bills receivables. So whenever a seller sells his goods or renders his services on credit basis, there appears the receivables. So these receivables are collected by a financial intermediary. That particular intermediary is called, financial intermediary is called a factor. Little bit information is given. It is a funding source that agrees to pay the company the value of the invoice less a discount for commission and fees. Say suppose a trader has sold goods worth rupees 1000 on a condition that the buyer has to repay the amount after 3 months, but the seller is not able to run his business without funds up to 3 months. So it is also a difficult task for him to run his business without cash. At the same time, without giving credit sales, without offering credit sales, it is also difficult for him to run the business. So here comes the crucial role of the factor. So what the client, that is the seller, does is he requests a financial intermediary that he has the evidence or he has sold goods on credit, and there is a possibility or there is a certainty of collection of the amount due by the customers. So he assigns, that is the client assigns the right of collection to a particular financial institution, whom we call as intermediary. So he provides advance money against those invoices by deducting some amount of money as commission or fees, or we call it as compensation for the services, factoring services rendered by him. So this is preliminary information about factor. Next concept what we have is what is factoring. What is done by factor is called factoring in simple. So factoring is an asset-based means of financing. Assets are nothing but bills receivables. So bills receivables, we call them as debtors. So debtors are current assets. So giving money against such current asset, we call it as factoring. we can just generalize the things based on its meaning. So again, we have a little bit information. It is an arrangement between a factor and his client, or we can also call the client as principal, which includes at least two of the following services to be provided by the factor. What are they? Financing and maintenance of accounts. So the factor has to lend money against the bills receivables, and he also needs to maintain the accounts, that is the maintenance of the sales ledger, we can call it as. So minimum these two facilities have to be rendered by the factor. Along with this, collection of the debts. He also provides protection against the credit risk, or that is nothing but if the client is not able to pay the debt, the factor is going to take care of that. He is going to shoulder the risk of taking the legal action or whatever is available according to the rules and law. Next, we have the parties involved in factoring. So who are the parties in the factoring? The very first one is the seller. There must be a seller, or we also call him as a trader, who offers goods and services for on credit basis. Next party, a debtor. Debtor is the one who purchases goods and who avails services from a trader or a seller on credit basis. The factor, that is the link between the seller and the debtor, who provides the factoring services. Next, we have you know functions of factoring. Let us see what are they. So purchase and collection of debts. So a factor usually purchases the receivables, that is bills, and he lends money against those bills, or else he will also collects on behalf of the seller. Next function is sales ledger management. So whenever the producer or the trader sells the goods, the factor will maintain the records of the buyers. We can also call it as the ledger of the debtors or ledger of the sales. Next function rendered by the factoring agent is credit investigation and undertaking of credit risk. What is this credit investigation is? This we can also call it as consultancy services, as the factor will have the precedent experience or behavior shown by the purchasers, that is the one who buys the goods on credit basis. His payment behavior, a consistency in the payment will be known by the factor. So that investigation can also be done by him for a new trader, and he also undertakes the risk of credit. In the event of the failure of the payment by the customer, the legal action would be taken by the factor. Next function, we have provision of finance, as we have already discussed in the meaning. So a factor funds a business firm against the receivables. Next, we have the process involving factoring. Let us see. The first stage is the first step is the client, that is the client sells the goods to buyer and prepares invoice with a notation that debt due on account of this invoice is assigned to and must be paid to the factor. That is the right of the collection of the money, that is the money due by the buyer, is given to the or is assigned to the factor, and the same has to be paid to the factor. So this clause is mentioned on the bill. So on the event of credit sale, this notation is put on the invoice. Next we have is the client, that is the seller, submits the invoice copy only with the delivery challan showing the receipt of the goods by the buyers to the factor. So once the seller sells the goods, he makes sure that the goods are delivered to the doors of the customer and the same has been received by the customers. So the sales bill and the delivery challenge will be given to the factor to to show it to the customer whenever he visits to the collection of the debts. He is nothing but the factor. The third phase we have is the third stage. The factor, after scrutiny of these papers, allows payment, that is the financing. Usually up to 80% of the invoice value would be given as the funding. The balance is retained as retention money, or we also call it as margin money. This is also called factor reserve. Depending upon the creditworthiness of the customer, the margin would be decided. Even after the 80%, the rest of out of 20%, the rest of 10 or the 15 would be paid back after the receipt, and the balance would be retained as the commission or the discount. The next is the concept is continued, so that is the mechanism of factoring. Uh, the drawing limit is adjusted on a continuous basis after taking into account the collection of factored debts. That is the financing amount, the degree to which uh, the seller can draw amount from the factor is decided based on the you know taking into based on uh, the collection factor debts, how much has been collected so far. Next, once the invoice is honored by the buyer on due date, the retention money credited to the client's account. In the previous point, we had that the factor would advance the money to the extent of 80% and the rest would be retained as retention money. So, out of that, if the factor is working for a commission basis, after paying the full settlement, he would claim for the commission, or if it is a discounted one, the factor would remain his portion of commission before the payment of the debt as 100%. So he would pay either 90 or 95% out of the collected money of 100%. Next we have is till the payment of bills, the factor follows up the payment and sends regular statements to the client. So as their responsibility, the factor will follow up the dates or datas, and he continuously sends the regular status of the payments to his principal or client. So here ends the stages involved in factoring process. Now we have arrived at multiple choice questions. Let us see one by one. The process of selling trade debts of a client to a financial intermediary is called discounting, factoring, forfeiting, debtor. The right answer is option B, it is factoring. The next question we have is trade debts have to be assigned in favor of the financing company under, we have directly called the answer. The options are like this: discounting, factoring, forfeiting, data. The right option is it is factoring. While assigning the animations, the answer has been given the first animation. So next we move forward to the third question. Under factoring, the factor acts in the capacity of an agent of his client, a trustee, a holder of value, a holder for value, an administration, administrator, and so these are the rules or the capacity, different capacities, how a factor acts in the factoring stages. So let us see the right capacity in which he acts in the factoring. So the right answer is a holder for the value. So he acts as a holder for the value. We usually see the same kind of relationship in the bailer and bailey concepts. Next, the fourth question. The first bank in India to start factoring business is Canara Bank, State Bank of India, Punjab National Bank, Allahabad Bank. The right option is State Bank of India is the first bank to offer factoring business. The fifth question. The balance money retained as retention money by the factor is also known as margin money, factor reserve, both A and B, none of the above. Let us see the right option. It is option C, that is both A and B. So margin money, factor reserve is what? Is also called retention money by the factor. So here ends. This is the sources of references. You can also refer. So here ends the concept for the 22nd session. So thank you. We will catch up in the next session.